Good afternoon to all of our listeners and viewers from across the U.S. We are certainly happy that you could join us this week. There's a lot to talk about. Now, this week in particular, we know that in the press, in the media, there's been a lot of concern, a lot of discussion around inflation. And it is an important conversation. Inflation impacts our daily lives. So what we're going to review this week is the impact of inflation, not just on our pocketbooks, but on our portfolios. Because in the media, we listen to or we hear a lot of fear surrounding inflation. But for us as portfolio managers and investors, we want to understand primarily how can we make money off inflation? What are the companies, the sectors and companies that are positioned to do well, not just during times of inflation, but also those post-inflationary periods as well. So we're going to zero in on that, what we're doing, how the portfolio is positioned, and the path ahead. So let's go ahead and get started here. I'm going to share my screen, and you'll notice that the title of this week's presentation is Inflation Beats Inflation. And maybe not the most creative title in the world, but the point there was, if you can't beat it, join it. And when we think of investors, us as investors, we have a few options, and we've talked about this in the past. We can hold cash, we can have real estate, we can own stocks, bonds. Those are the four primary things that we can invest in. And of course, some hard assets such as gold. And then I know we have crypto as a more sort of fringe asset there. But what we want to really focus on is if the alternatives such as owning bonds and cash are not great during inflation, then what specifically in the stock market is attractive to own? And secondly, we want to make sure that we don't get scared out of the stock market same way that a lot of investors have over the last 12 years. Inflation is just the latest boogeyman. Do we think inflation is going to be rather sticky in that 3 to 4% level for the next 12 months? We do. But we don't think it's going to stick at 6, 7, or 8%. We're going to go through why. And if we stick at 3 to 4%, there's a lot of companies that do really, really well in that type of environment because it's primarily driven by higher nominal GDP growth. So the three big takeaways from this week is that the bottlenecks are beginning to ease. What does that mean? That means we may see the first signs that inflation is peaking out in 2022. Now, I want to take a step back. That doesn't mean inflation is going away. That just means it's peaking out. That rate of change, a second derivative, is getting less bad. And that's what we care about as investors because that's what's not priced into the market. Number two, reopening stocks are poised to continue their outperformance relative to their stay-at-home peers. We're going to go through the charts. We want to pay attention to those symptoms and then act accordingly. Number three, energy stocks really are a great way to hedge against inflation. We're going to go through some of those historical reasons why, and then more specifically, what that relative performance versus the market looks like right now. Now, we've gone through this chart many times, but you'll notice inflation is just the latest episode to hit the stock market over the very, very short term. This is nothing compared, obviously, to the pandemic. Inflation, though, in particular, does elicit a lot of emotion because we see it every single day, whether it's at the gas station, whether it's at the grocery store. We feel it, and we feel it in the most important area, which is our pocketbook. Now, the best way to protect against that, of course, is to make sure our portfolio is inflating higher than the rate of inflation. And so if we own bonds at 1%, if we are renting out real estate with a 4% cap rate, or we have cash at 0%, we are losing the battle against inflation. But if we own good companies that are growing their earnings 15, 20% a year, even 10% a year, and that is falling down to the bottom line and leading to higher stock prices, ideally, then we're beating inflation. And that's the ideal world we want to position investors in against this current environment. So we saw inflation this week, came in at that 6% level, certainly a psychological breach of that 6%, but when we look forward to 2022, which we have to do, there's only a month and a half left in 2021, we see a few things. One is that rate of inflation is going to begin to slow according to some of the research that we look at and do here at LifePro. We'll go through those specific reasons why, but it's in particular related to the supply chain. A lot of those bottlenecks have caused broad-based price increases. Those are already showing signs of easing, and that should ripple through in CPI starting in January, February, and March of next year. So we look at something else called PMI, which is your producer price index. So the PPI, not PMI, the PPI index, which is your producer price index, that is what we call your upstream inflation. So in other words, if you're Apple, you have to order parts from Taiwan Semiconductor and other parts suppliers. Those prices have already started to flatten out. So that happens first, and then you see it in the CPI later on, which is this number here, which everyone was talking about this week. So number two, earning estimates continue to increase. So we're already seeing those earning estimates go from under $200 a share for the S&P 500 to well in excess of close to $220 a share for the S&P 500 in 2022. How do you beat 5% inflation? Well, buy companies that are growing their earnings 15, 20%. That's a great way to do that. And then, of course, we want to buy assets that offset inflation, right? So here's a great example of this is if you own cash or treasuries, this is the 3-month treasury bill rate, and this is inflation. That difference, that gap is what you're losing. Now, the 10-year treasury is at 1.5%. So if we follow my mouse here, it's about right here. So you're still losing about, call it 4.5%. If you have corporate bonds that yield about 2%, then you're still losing 4% or 3.5%. So what we want to do is make sure that whatever we're invested in can offset that impact of inflation. We see a lot of clients that will say, not clients, but investors just broadly speaking, that say, oh, inflation, that's awful. Okay, I'm going to sell and go to cash. Well, that's even worse because now your cash is getting inflated away at 6%. So we want to have the offset. We want to be positioned in assets that do well during times of rising prices. And then here, and I apologize, I forgot to label the chart here on the right, but what this chart on the right is the S&P earnings growth rate. And you can see here, again, north of that 12% level for earnings growth. So 12% is what? Above 6%. So that's an important point that we want to keep in our back pocket. If earnings are growing faster than inflation, that's real wage growth or real income growth for those companies. And then, of course, we talked about the upstream impact and what its impact is on inflation. And so, what we see here is already Asian manufacturing output is starting to accelerate. And what we see is those Taiwan supplier delivery times are starting to ease back a little bit. Where we haven't seen it is here in the US. The delivery times are still extending out. And you're seeing that play out in the inflation numbers because the US is the end market typically versus vice versa of shipping things over to Asia. And if Asian manufacturing is beginning to catch up, we know we import a lot from Asia, and we see Taiwan supplier times beginning to ease back, because remember, a key component of that has been the chip shortage. Then we should start to see that flattening out of PMIs play out in the flattening out of CPIs, which is the inflation number that happened this week, early in 2022. Now, when it comes to actual stocks, we remain focused on the reopening. Virus counts continue to be subdued, especially now with the emergence of the Pfizer medication that actually reduces the lethality of COVID-19. So what we're really seeing is the pandemic's transition over to what we call an endemic, which in other words, we're going to start just living our lives normally with precautions, but we're going to start to live our lives normally. And we can see here is that while a lot of industries have gotten back to work and cities have gotten back to work, we're still well off our peak. And what that tells us is we still have a lot of work to do, and mind the pun. And if there's a lot of improvement yet to be had, a lot of the stocks that benefit from the reopenings are also relatively cheap. And we can also see here, in terms of the economic health, the percentage of companies planning to increase employment continues to increase. So again, this just doesn't happen ahead of recessions. And then, as you know, we like to read the tea leaves. We like to read the symptoms of the stock market. So what's happening with those stay-at-home stocks that do well, have tended to do well during the pandemic? They're all relatively collapsing. You know, whether we look at Chegg or we look at Peloton or Zillow or Moderna or Zoom, you know, these are stocks that we sold earlier in the year, and we got a little bit of flack for it, and the truth is, thank God we've sold them, right? And I think now the focus is how can we rotate that money and those assets into companies that are going to do well in a more cyclical, a durable cyclical recovery, especially now that we have an influx of close to $1 trillion in infrastructure spending that's going to hit the economy here over the next 12 to 24 months. And then in terms of energy remains strong leadership within the stock market. So when we look at the percentage of stocks, both in absolute and relative uptrend relative to their peers across the stock market, and of course their absolute price performance, energy and real estate are at the top of the heap. And we know right off the bat, what are the three sectors that do well during inflation? Real estate, energy, and financials. So that's no surprise that these sectors continue to offer durable long-term leadership within the stock market. So right now, over 90% of energy stocks are in an absolute and relative uptrend. Now, when we look at the energy, relative to the S&P 500, you see that relative performance here is starting to break out again. And I think that's important. Now, we've had sort of flattening out, and you've probably seen it in the performance of the portfolios that, after a massive rally for 3 months, the last couple of weeks has been up and down a little bit, more to the upside, but not the same sort of velocity. And that's a lot of these energy stocks are taking a breather. It's obviously been a strong 2-3 month period. So now consolidating before that next resumption higher. Now, the good news is, in terms of ETF flows into energy, still rather subdued. It's when you get into these these 2 standard deviation levels that you want to take, you want to be a little bit concerned about, where you say, hey, this sector might be a little bit overheated, a little bit overbought. So that's something we're watching, but we're nowhere close to that. And that's actually one of the feathers in our cap right now, and saying, hey, not only is energy doing well, but we're nowhere near an overheated position. And then, of course, we want to ask ourselves is, when energy is going through a period of durable leadership, what does that actually mean for future performance if we look at the historical track record? So from a historic standpoint, when energy is outperforming this much and is got this number of stocks in both a relative and absolute uptrend, the 6-month performance of energy stocks tends to be around plus 7.3%, 6 months moving forward. So what does that mean? Well, that means you're in the strongest quintile, strongest quintile from a historical standpoint. So strong performance is good. Strong relative performance is even better. And it doesn't mean things are overbought. It tends to actually strength begets strength going forward. And of course, is energy expensive or cheap? Well, this is Tesla versus all the energy companies on the S&P 500. And again, I would argue that I'll take a collection of these companies versus putting all my money in one company, thinking that it's going to be the end all and be all across the world. And credit markets, as usual, remain healthy. We want to stay focused on this, but if there was any problems percolating in that global economy, you would really see it there first. So the bottom line is, listen, during times of rising prices, the worst thing that we can do is to try and own assets that ultimately rise less than the rate of inflation. That leads to losses, and we don't want that. And that leads to a decrease in our purchasing power and our realized income. We don't want that. So what do we need to do? We need to invest in stocks that do well during times of rising inflation. Energy and bank stocks, along with REITs and real estate, tend to be well positioned to make money during times of inflation. Lastly, as these bottlenecks start to ease in the supply chain, we've already started to see an easing back of those PPI figures, those producer price index figures. We expect that to play through into the end CPI or inflation figure in early 2022. The market tends to sniff this stuff out ahead of time. Notice how copper and copper stocks have been acting so well the last couple of days. It's sniffing something out. What we are experiencing here is not a slowdown in economic growth. It's actually an acceleration in the rate of economic growth that we'll see play out in the numbers in Q1. So the economy looks great. Yes, we have some uncomfortable inflation, but we're already seeing that rate of change in the supply chain start to slow. And ultimately, a lot of these cyclical reopen stocks are very well positioned to deliver high earnings growth, and right now are available at a very, very cheap price that makes us excited in terms of trying to buy great companies at low prices. So if anyone has any questions, please feel free to reach out to us, and please feel free to reach out to your advisor, and be more than happy to help. Have a great weekend, and thank you again.